In today's market, some of the biggest opportunities for investors lie in places most people overlook. While the mainstream is chasing after big defense names like Lockheed Martin and Northrop Grumman, there's a quieter corner of the market where massive potential exists: low-priced defense stocks. These are the types of stocks that might seem small and insignificant today, but with the right contracts, partnerships, and financial discipline, they can deliver returns that could turn small investments into millions. So today we are diving into 3 of the best low-priced defense stocks to buy now that have the potential to make you rich if you get in before the big wave of institutional money arrives. So if you're serious about making money in the stock market, make sure to watch until the very end, and don't forget to subscribe and turn on notifications so you never miss an update on the hottest stocks in the market. First on the list is CIFCO Industries Incorporated, trading on the NYSE American under the ticker SF. CIFCO is a fascinating company because it has been around for decades, serving some of the most important industries in the world, producing forgings and machined components for aerospace, defense, energy, and even commercial space markets. These are not flashy products, but they are critical parts of larger systems, which means once you're embedded into military supply chains, you stay there for years. The company has recently caught investor attention because its stock has surged nearly 67% since May 16th, following the announcement of its second quarter and first half results for fiscal 2025. For the quarter ended March 31st, the company reported net sales of $19 million, which was down 7.3% compared to the $20.5 million in the same quarter of fiscal 2024. This decline was mainly attributed to raw material sourcing challenges that have been affecting the entire industry. However, the real story here is in profitability improvements. Net loss from continuing operations narrowed to $1.3 million, or 22 cents per diluted share, compared with a loss of $2.2 million, or 38 cents per diluted share, last year. That's a clear sign of better cost controls and operational improvements. From discontinued operations, the company reported only a minor loss of $0.1 million, whereas last year it had posted net income of $0.6 million in that segment. On the profitability side, EBITDA came in positive at $0.4 million, compared to $0.2 million a year ago, signaling progress. However, adjusted EBITDA was slightly weaker at $0.2 million compared to $0.2 million previously. What's important to understand here is that the company is showing signs of stabilizing its operations despite supply chain issues. At a current stock price of $6.84, CIFCO still looks like a bargain in a sector where defense contractors often trade at much higher multiples. Short-term forecasts even suggest some upside with price targets of $6.96 within one day, $7.15 within 1 week, and $7.26 within a month. The long-term projections are more conservative, estimating $5.05 by 2026 and $5.65 by 2030, reflecting the cyclical risks in aerospace and defense. Second on our list is CPI Aerostructures Incorporated, trading under the ticker CVU on the NYSE American Exchange. CPI is another under-the-radar defense stock, but one with a long history of serving both commercial and military aviation. The company specializes in manufacturing structural parts for fixed-wing aircraft and helicopters, and its capabilities have earned it a strong reputation in fusion welding technology. Just recently, on July 30th, CPI Aerostructures announced it was awarded follow-on orders worth $2.4 million from multiple customers to weld complex structural assemblies used on a U.S. military helicopter. This wasn't just another contract. It was a strong validation of CPI's reputation in the defense industry. For its most recent quarter, revenue dropped to $15.2 million compared to $20.8 million a year ago. Gross profit also fell sharply to $0.7 million compared to $5.1 million in the same period last year. This pushed gross margin down to 4.4%. Although if you exclude the 8-10 program impact, margins were closer to 17.1%, still weaker than the 24.6% recorded a year earlier. Net results also showed a swing from profitability to loss, with net income of $1.4 million last year turning into a net loss of $1.3 million this year. Earnings per share similarly flipped from a positive 11 cents to a negative 10 cents. Adjusted EBITDA declined to $1.7 million from $2.6 million. Although excluding the A10 program impact, adjusted EBITDA was a more respectable $0.6 million. What these numbers tell us is that CPI is dealing with program-specific pressures that weighed heavily on profitability. But at the same time, its underlying business, excluding those issues, remains in much better shape. This is why the new $2.4 million contract is important. It shows the company continues to secure defense work despite financial volatility. The future potential for CPI is linked to its ability to win and execute contracts effectively. If management can stabilize margins and keep securing deals like the helicopter structural assembly orders, the stock has plenty of room to grow from its current $2.80 level. For investors looking for a speculative defense play with strong upside potential, CPI fits the bill. Last on our list is Momentus Incorporated, trading on NASDAQ under the ticker MNTS. Unlike the first two companies that are focused on traditional aerospace and defense manufacturing, Momentus operates in one of the most exciting frontiers of the defense industry, space. The company offers satellite buses and in-space infrastructure services, including hosted payloads, in-space transportation, and other orbital solutions. It is also gaining traction in defense-related space programs, which could be a massive growth driver. Just last month, Momentus announced that it had secured a $1.86 million Small Business Innovation Research, currently priced at $1.28. The stock looks beaten down, but that may actually present an opportunity for investors who believe in the company's future. Financially, Momentus reported a net loss of $6.45 million in the second quarter of 2025, an improvement from the $7.02 million loss a year ago. Basic loss per share was $1.23 compared to $5.92 last year, showing progress thanks to restructuring and changes in share count. For the 6-month period, net loss stood at $12.62 million versus $15.33 million last year, with loss per share improving from $14.72 to $2.81. These numbers highlight that while losses remain significant, the company is gradually making progress in reducing them. According to recent forecasts, MNTS stock could rise by 3.22% to reach $1.35 by September 19, 2025. Market sentiment remains bearish overall, with the Fear and Greed Index showing a level of 39, signaling fear. However, the stock is trading 5.69% above its forecast, suggesting that it may be undervalued relative to its potential. For investors willing to take on high risk for potentially high reward, Momentus could be one of the most exciting plays in the space defense sector. Well, that concludes our list of the 3 best low-price defense stocks to buy now. CIFCO Industries is showing strong momentum and improvements in profitability despite supply chain challenges. CPI Aerostructures continues to secure valuable contracts that reinforce its position in military aviation manufacturing, and Momentus Incorporated represents a bold bet on the future of space defense with its growing ties to the U.S. military. Each of these stocks trades at a low price today, but with the right execution and continued partnerships, they have the potential to multiply in value over the coming years. Remember, investing in low-price stocks carries more risk, but that's also where some of the biggest rewards can be found. So keep them on your radar, do your own research, and consider whether these opportunities align with your investment strategy.